Imagine someone offers you a video game cheat code that promises to triple your score every time you play. Sounds like a guaranteed win, right? In the stock market, Wall Street sells investments that sound just like that cheat code. They are called 3 times leveraged funds, and they advertise a simple idea. If the stock market goes up by 1% in a day, your money goes up by 3%. Most people look at that and think, if the market goes up over the long run, holding a 3 times fund for a few years will make me 3 times richer. But as the diagram on the slide shows, that simple math is a total myth. Look at the middle gear labeled the leverage ETF engine. It looks shiny on the outside, but inside the teeth are broken and grinding against each other. That broken gear represents what actually happens under the hood. The reality is that these funds are mathematically engineered in a way that causes them to slowly lose money over time, even when the overall market goes up. Financially, we call this structural decay, which is just a fancy way of saying the fund is constantly bleeding cash out of a hidden hole in the bottom. Our purpose today is to do a forensic teardown, like crime scene investigators examining a broken machine. We are going to look at the 3 hidden mechanisms that destroy your money inside these funds: beta slippage, contango drag, and the daily reset mandate. By the end of this presentation, you will see why buying and holding these products isn't an investment strategy at all. It's a high-tech trap designed to quietly wipe out your savings. To see how this trap plays out in the real world, let's look at the actual financial autopsy of a fund called SQQQ. This fund is designed to do something very specific: give investors negative 3 times the daily return of the Nasdaq 100, which is the index containing America's top tech companies like Apple, Microsoft, and Amazon. On the left panel, you see the actual Nasdaq 100 index from 2018 to 2023. Over those 5 years, despite a few bumps along the way, tech stocks trended strongly upward. Now look at the right panel showing SQQQ. Because SQQQ bets against tech stocks, you would expect it to go down when tech stock goes up. But look at how brutally it collapsed. It plummeted straight into the floor. Notice those yellow warning triangles labeled reverse splits. A reverse split happens when a stock's price drops so close to zero that the company has to forcibly combine shares just to keep the stock alive. It's like taking 4 quarter coins, gluing them together and calling it a dollar bill because a quarter isn't worth enough on its own. SQQQ had to do this repeatedly just to stay listed on the stock exchange. Look at the diagnostic data panel at the bottom. Imagine an investor put $2,300 into SQQQ and then completely forgot about the account. 5 years later, they logged back in, expecting to see their money. Instead of 2,300, they were left with just $368, a massive 84% total loss. Here is the forensic conclusions. This investment didn't die because of a sudden market crash. It died slowly because time and market bounce caused exponential decay. The investor was penalized simply for holding the position while time passed. Why does this happen even when the market is doing well? To find out, researchers ran a massive computer simulation. They tested 20,000 different market scenarios over a full year. In every single one of those 20,000 tests, the stock market was guaranteed to finish the year up between 8% and 12%. However, the market wasn't a straight lineup. It had normal daily price bumps and zigzags along the way. Look at the outcome matrix in the middle of the slide to see what happened to different types of funds in those exact same market conditions. First, a standard one-time fund tracking the S&P 500 did exactly what you'd expect. It finished up between 8% and 12%. Next, a 2 times bull ETF was expected to deliver double that, around 16% to 24%. But in reality, because of daily market bumps, it only averaged a tiny 3.1% gain. Finally, look at the 3 times bull ETF. Straight line math says a 3 times fund should have made a huge profit between 24% and 36%. But in reality, the 3 times fund averaged a loss of 17.7%, with some scenarios wiping out 32.5% of the investor's money. Let that sink in. Across 20,000 simulated worlds where the stock market always ended up higher at the end of the year, the 3 times fund never once delivered a positive return. Positive overall market performance still resulted in massive losses for the 3 times fund. This proves that simple multiplication doesn't work when you hold these funds through bumpy market conditions. Now we have to ask the big question. Why does the math break down like this? The answer lies in the clock mechanism shown on this slide. The daily reset mandate. When a company creates a 3 times leveraged ETF, the contract contains a critical rule that most people miss. The fund manager promises to deliver triple returns for one single day only. The clock resets every single afternoon at 4 p.m. when the stock market closes. Let me walk you through how this daily clock cycle works in practice. First, at market open, 9:30. The fund starts with a fresh leverage ratio. If the fund has 100 million in real cash from investors, it uses financial contracts to control 300 million worth of stock market exposure. That is a perfect 3 times ratio. Next, during the day, intraday. Suppose the market goes up by 2%. The fund's stock exposure grows from 300 million to 306 million, and its cash assets grow to 106 million. The imbalance, 3:30 p.m. Notice what happened to the ratio. 306 million divided by 106 million is no longer 3 times. It has dropped to roughly 2.89 times. The fund is no longer properly leveraged for the next morning. The forced reset, 3:30 p.m. to 4 p.m. To fix this imbalance before tomorrow's opening bell, the fund manager is legally forced to go into the market and buy an additional 12 million worth of financial contracts. That brings us to the core synthesis at the bottom of the slide. The 3 times label on the bottle strictly applies to a single 6.5-hour trading session. There is absolutely zero guarantee that these returns will compound over a week, a month, or a year. Because the fund manager has to perform that forced reset every single afternoon, something bizarre and dangerous happens. It forces the fund to break the golden rule of investing. Everyone knows the basic rule of making money: buy low and sell high. But as the infinity diagram on this slide demonstrates, a daily reset leveraged fund is mechanically forced to do the exact opposite. It buys high and sells low every single day. Follow the green gear on the left side of the infinity loop. When the stock market has a good day and prices go up, the fund's assets base grows. But To maintain its required 3 times ratio for the next morning, the fund is forced to go out at 3:55 p.m. and buy more financial contracts at the absolute highest price of the day. Now, follow the red gear on the right side. When the stock market has a bad day and prices drop, the fund loses money. To prevent its debt levels from ballooning out of control on a shrinking cash balance, the fund is forced at 3:55 p.m. to sell off financial contracts at the absolute lowest price of the day. Look at the diagnostic callout in the center. If the stock market shoots straight up like a rocket without ever dropping, this system actually works nicely. But in a normal, choppy market where prices zigzag up one day and down the next, this daily routine acts like a high-friction paper shredder. Every single time the market zigzags, the fund buys at the top and sells at the bottom, constantly bleeding your money away. Let me show you a simple step-by-step math example so you can see this paper shredder effect in action over just 48 hours. Look at the bar graph on this slide starting on day 0. Suppose you put $100 into a regular 1 times index fund and another $100 into a 3 times bull ETF. On day 1, the market goes up by 10%. Your regular index fund grows by 10%, going from $100 to $110. The 3 times ETF triples that gain to plus 30%. Your $100 grows to $130. You're feeling like a genius. Now look at day 2. The market experiences a normal pullback and drops by 9.09%. For the regular index fund, losing 9.09% of $110 means taking off $10. Your balance drops right back to 100. Over 2 days, the market is completely flat, a 0% net return. But what happens to the 3 times ETF? It must triple the day's 9.09% drop, so it suffers a 30% loss. Here is the critical catch. That 30% loss gets applied to your new higher balance of $130. 30% of $130 is a massive 35.45 cents loss. Taking $35.45 away from 130 leaves you with just $94.55. Look at the bracket on the right labeled the decay gap. The underlying stock market went up and down and ended up at the exact same dollar amount it started with. But your 3 times ETF permanently lost 5.45% of its value in just 2 days. That's missing cash, and it's pure mathematical friction, and you can never get it back. If 3 times bull funds lose money during choppy markets, you might think bear funds, funds that bet against the market, would be a safer edge. But, as this slide shows, bear funds actually bleed cash even faster due to something called the base effect. Look at the top diagram labeled the 1 times inverse illusion. Imagine the market drops by 10% on day 1 and drops another 10% on day 2. The stock market drops from 100 to 90 and then from 90 to 81, a total loss of minus 19%. A simple 1 times inverse fund goes from 100 to 110 and then from 110 to 121, a total gain of 21%. Notice that because the fund's base got bigger on day 1, the second 10% gain yielded more dollars. That sounds great. But look at what happens when the market goes up instead. Look at the weighted seesaw diagram at the bottom. The stock market has a historical tendency to trend upward over long periods of time as businesses innovate and grow. When the market goes up, a bear fund loses money, which rapidly shrinks its cash balance, its asset base. This creates an extreme mathematical trap. If an investment loses 50% of its value, say dropping from $100 down to $50, how much does it need to gain just to get back to $100? It doesn't need a 50% gain. It needs a 100% gain just to break even. Because daily resets shrink a bear fund's asset base very quickly during market rallies. The mountain it has to climb back up gets steeper every single day. Now let me show you an even worse trap hidden inside commodity and volatility funds like oil ETFs, like BOIL, or Fear Index ETFs, like UVIX. These ETFs don't buy physical barrels of crude oil or giant vaults of gold because storing physical stuff is too expensive. Instead, they buy paper contracts called futures, agreements to purchase the commodity at a specific date in the future. Look at the staircase graphic on the slide. In normal market conditions, a futures contract that expires next month, labeled M2, almost always costs more than a contract expiring today, labeled M1. This upward sloping price curve is known in finance as contango. Here is how contango bleeds the fund dry, step by step. To keep the fund open month after month, the manager cannot let contracts expire and take delivery of actual oil barrels. Therefore, every single day, the fund must sell its expiring cheaper contracts, M1, at the top of the stairs, and use that money to buy next month's more expensive contract, M2, at the bottom of the stairs. Think about what that means every day. The fund is systematically forced to sell low and buy high just to keep operating. Look at the impact data box on the right. This endless monthly rollover creates a constant drag of roughly 5.6% every month. Even if the price of oil doesn't move an inch all year, the fund will lose a massive chunk of its value, simply paying the penalty of rolling over its contracts. Beyond mathematical decay and contract rollover, there is a third way these funds drain your money: hidden Wall Street fees. Look at the comparison table on this slide between a standard, plain vanilla index fund like SPY on the left and a 3 times leveraged fund like UPRO on the right. Management expense ratio. Standard SPY charges a tiny fee of 0.09% per year. UPRO charges 0.93%. That's a base fee 10 times higher. Borrowing costs. SPY doesn't borrow money, but UPRO has to borrow $2 extra for every dollar you invest. It pays bank interest rates on all that borrowed money, passing the interest bill straight to you. Hedging agreements. To maintain its 3 times ratio, UPRO pays big Wall Street banks for specialized financial contracts called swaps. These swap fees add up to an extra 5.5% in annual costs. Trading slippage. Because these funds are forced to do massive trades during the chaotic last 30 minutes of the trading day, they often get worse execution prices. It's called slippage. Look at the red synthesis box at the bottom. Even if the stock market stays completely frozen and volatility drops to zero, Just holding a 3 times fund subjects your cash to a 2% to 3% annual fee drag before the market even opens in the morning. You are paying a premium ticket price every single day for a ride that is constantly breaking down. We have looked at a lot of moving parts. Now let me bring them all together into one simple master formula shown inside the glowing box on this slide. So the total value destruction equals the leverage ratio squared times market volatility times time. Let's break down those three main ingredients. So the leverage ratio squared. Notice that the leverage factor isn't just multiplied, it is squared. A 2 times fund decays 4 times faster than a 1 time fund. A 3 times fund doesn't decay 3 times faster, it decays 9 times faster. Now you have the market volatility. This measures how wild the daily price zigzags are. The bigger and more frequent the daily price swings, the faster the daily reset process grinds down your investment. Time is the compounding catalyst. The longer you hold a leveraged ETF in your account, the closer your probability of losing almost everything approaches 100%. Look at the final takeaway at the bottom of the slide. In any market that experiences normal ups and downs, long-term capital ruin for a 3 times fund isn't just a possibility or a bad luck scenario. It is a mathematical guarantee. The math is stacked against you from day one. Despite all these mathematical warnings, Wall Street continues to create and market these funds to everyday retail investors. On this slide, we have documented what we call the ETF graveyard, a list of some of the most popular leveraged funds on the market today. Look at the table on the right side showing the 10 most active decay-prone ETFs. TQQQ, 3 times Nasdaq 100. This is the largest leveraged ETF in the world, holding over $32 billion in investor cash. People buy it thinking tech stocks will always go up, unaware of the daily reset friction. SOXL, 3 times semiconductors, and NVDL, 2 times Nvidia. These funds track microchip makers of hot AI stocks. Because individual tech stocks are incredibly volatile, these funds decay at hyper speed during market pullbacks. TSLL, 2 times Tesla, a single stock leveraged fund tracking Tesla. When a stock experiences 5% daily swings regularly, a 2 times daily reset fund bleeds cash like an open wound. Look at the 3 toxic archetypes listed on the left panel. Whether it's VIX volatility funds like UVIX, triple leverage bear funds like SQQQ, or leveraged commodity funds like BOIL, they all share the exact same fatal flaw. Remember the warning line at the bottom of the slide. If the structure decays, no thesis can save you. You could be 100% right about the future of AI or electric cars, but if you choose a broken financial container to invest in, you will still end up losing money. To drive this point home, let's look at a real-world simulation of 2 crude oil ETFs over a 72-day trading window, about 3 months. Imagine a scenario where the price of crude oil goes on a wild, chaotic roller coaster ride over 3 months, but at the end of those 3 months, oil finishes at the exact same price it started, a net change of 0%. Look at what happens to the 2 daily leveraged funds tracking oil. Scenario B, bottom branch. An investor buys UCO, which is a 2 times long oil fund, betting oil will go up. Because of daily zigzag friction, UCO loses 4.1% of its value over those 3 months, even though oil didn't drop at all. Now, you might think, if the fund betting on oil lost money, then the fund betting against oil must have made money. But look at SCO, the 2x inverse oil fund betting oil will go down. Over that exact same period, SCO lost a crushing 13.2% of its value. Read the key insight in the center box carefully. When an asset zigzags aggressively but ends up completely flat, both the long fund and the inverse fund lose money at the exact same time. You can bet on heads or you can bet on tails, but the mathematical structure of the coin ensures that both sides lose. You might wonder, is there any amount of leverage that is safe? To answer that, financial mathematicians use a famous formula called the Kelly criterion, named after scientist John Kelly. It calculates the absolute maximum amount of leverage you can use on an investment without guaranteed bankruptcy. Look at the gauge visual on the left, the safe zone blue. This represents optimal leverage. As long as your leverage stays in the zone, compounding works in your favor. The ruin zone, red, once your leverage exceeds twice the optimal limit, the math flips upside down. Your expected long-term growth rate turns negative, guaranteeing capital destruction over time. Now look at the data panel on the right, comparing two different markets. Broad equities, the S&P 500, standard stock market volatility is around 15%. The Kelly criterion calculates that the optimal maximum leverage for the S&P 500 is about 2.67%. 2.67 times. This means 3 times leverage is slightly over the line, but might survive during strong bull markets. Semiconductors, SOX index, microchip stocks are much wilder, with an average volatility of 30%. Because the market is twice as wild, the math says the optimal maximum leverage drops to just 1.17 times. When Wall Street sells a 3 times semiconductor ETF like SOXL, they are applying 3 times leverage to an asset that can only mathematically handle 1.17 times. That pushes the risk needle deep into the red ruin zone, making eventual failure absolute certainty. Because these products are so dangerous for ordinary people, financial government regulators around the world have issued stern public warnings. Look at the 3 official documents displayed on this slide. FINRA, the Financial Industry Regulatory Authority, explicitly warns that daily reset leveraged ETFs are unsuitable for retail investors who plan to hold them for longer than a single trading session, which means 1 day. The Securities and Exchange Commission, the SEC, actively takes legal enforcement action against financial advisors who quietly buy and hold these leveraged funds inside client accounts without continuous risk monitoring. Zero in Canada, you got the Canadian regulators, they went even further. They mandated strict warning disclosures and banned 3 times daily products outright, placing an absolute legal cap on physical leverage at 2 times. Look at the synthesis box at the bottom. Professional financial regulators do not view these products as normal investments like stocks or mutual funds. They classify them strictly as short-term tactical trading tools, like a scalpel used by a surgeon. In the hands of a professional for 10 minutes, it's a precise tool. In the hands of someone who leaves it in their pocket, it causes serious harm. If these funds are so dangerous, how should professional traders handle them? On this final slide, we lay out the strict rules of engagement for using leveraged products safely. Follow the 4-step tactical blueprint. Rule 1. Time constraint. The melting ice cube. Treat every leveraged position like a melting block of ice in your bare hands. Hold them for intraday trades or 24 to 48 hours maximum. Never under any circumstances buy and hold them long term. Rule 2. Position sizing. Never size your trade based on the label. Putting 10% of your money into a 3 times fund does not equal a safe 30% stock position because the leverage ratio shifts every day. Keep position sizes extremely small. Rule 3. Market regime check. Only deploy leveraged funds during extremely strong, smooth, single direction trends with low volatility. The moment the market enters a choppy sideways zigzag, exit the trade immediately before the paper shredder effect starts. Rule 4. Use options for hedges. If you want to protect your portfolio against a market crash over several months, don't buy a 3 times bear ETF. Use standard put options instead. Option time costs are predictable and linear, while daily reset decay is exponential and uncontrollable. Remember the final directive at the bottom. Leveraged ETFs are strictly short-term trading tools, not long-term investments. Follow these rules or face guaranteed loss of your hard-earned money.